Yeah, we've got another read now with CSX, sticking with the transports. Those shares are higher despite reporting mixed third quarter results and citing weaker rail demand. Our Morgan Brennan is here at Post 9 to discuss along with a special guest. Hi, Morgan.
Hi, it's good to be here. Yes, we have a special guest, and that is the CEO of CSX, Joe Hinrichs. Joe, thanks for being with us today.
Good morning. Thanks, Morgan.
So CSX actually does a lot of work with J.B. Hunt, and when we hear these comments about we're not out of a freight recession yet, how do you see it?
Well, actually, we're seeing, I'd say mixed results overall. Part of the issue is the international intermodal business. So things coming into the ports has been down all year and still down. We've seen that stabilize, but still down year over year. But encouragingly, we've seen growth now for the last several months of domestic intermodal business, which, of course, J.B. Hunt is a big provider of. In the U.S. economy. That's been encouraging to us. We showed that in our earnings last night, that for a number of months now, it's been growing year over year, and we're seeing that into the fourth quarter.
That's interesting. I wonder what you attribute that to, because we have a U.S. industrial economy that doesn't really seem to be growing based on the macro data. We know retailers are still working off these higher inventories, so to hear stabilization in that part of the market certainly gets attention.
Yeah, I think there's a couple of things. I mean, there was a significant destocking of inventory, and perhaps that's played itself out. Also, a lot of the things that we touch are more fundamental to the economy, not so much on the retail side, which, of course, is why I think the international intermodal has been down. But our merchandise business, which touches that industrial complex, we've actually grown volumes this year. But I think for CSX, what's playing out is our leading service numbers and the performance we're giving to our customers is bringing volume onto our network. And I think that's why you're seeing our numbers so strong compared to others.
Yeah, I want to get into that a little bit more, but first, just one more macro question for you, and that is, at a time where we are seeing economic data that is holding up and more resilient than I think many folks had expected going into this year, is that what you're seeing in real time, too, given the fact that you do move so many different types of goods across so many industries here in the U.S.?
Yeah, Morgan, we're encouraged by what we're seeing in the fourth quarter. I don't want to, get too far ahead of ourselves, but in the first three weeks of this month, we've seen growth in sectors that have been stagnant for most of the year. I'm going to specifically chemicals, plastics, where we've seen been down all year long. Obviously, coal and automotive and minerals and aggregates continue to be strong, but we're seeing some signs of optimism in the chemical side, which is our biggest sector. So that's one to watch. Pulp and paper is still a little bit short due to housing. We're watching that one as well. But we've seen an encouraging start to the quarter so far.
Okay, I want to get your outlook for pricing. And just as importantly, in a disinflationary environment that can be a double-edged sword, the outlook for costs.
Yeah, so on the pricing side, we've actually been very supportive this year. And, I think people see the value that rail provides both on ESG, but also on the total cost proposition. We have had labor inflation due to the labor contract, which went into force last year, and we're going to see more of that next year. We're running better, which is helping us offset some of those costs. If you look at our sequential costs from second quarter to third quarter, we kept them in line. But there definitely is some inflation on rail ties and all those kinds of things as well. And that's going to continue to eat into our business. We got to get more productive to help offset it.
You're talking about service. That's been a big focus for you at CSX since you took over, improving service metrics. You've been able to take market share. Where is that happening most meaningfully? Is it from your direct competitor in the eastern U.S., Norfolk Southern, which has been dealing with some of its own service and operational issues this year, or is it from the truckers?
Yeah, it's a little bit of everything across the board. I mean, you think about automotive. We've gained a couple points of share in automotive. That's largely been based on service. But also the intermodal business I talked about on the domestic side, we're seeing some growth there. We're hearing from our customers that our industry-leading service metrics and performance is leading to them leaning into CSX more. So our customers are very thankful. I was a customer for decades, so I'm never going to lose sight of the fact that our providing great service helps the economy and helps our business and our customers overall.